Hello everyone. I hope you're having a good day. And today we are going to dive deep inside the concept of financial securities and how the recent technology has shaped the finance industry as a whole. So before starting out, let's just have a quick brief of our university, like what our university does. So basically, it's a Times of India Group initiative, and I am Pratham Gupta from School of Computer Science, Engineering and Technology branch. I am pursuing BTech CSE, and currently I am in my third year. So the university is much more research specific. So as mentioning this, research at Bennett University is focused on finding sustainable solutions to the problems of the modern world. So as a part of curriculum only, students are trained to design mini projects, research paper reading, presentation, and are encouraged to participate in conference presentations and academic competitions, right? So let's now hop into the main stream of our presentation. So now let's start with a detailed and informative study of the financial securities. So the topic name is of course financial securities and a leap towards technology. So before jumping onto any concept, we should have a basic framework of what we will be covering ahead of the session. So we will be knowing the basics of the securities, like discussing about the types of securities also. We will be then comparing the ROI between these securities, and then we will be understanding the derivatives in detail. And we will see how the technology has shaped the whole finance industry to an efficient working economy, and the implications of DeFi and Web3, of course, like how these things is now picking up the pace and how they can really transform the finance industry as a whole, like the bond market, the stock market, everything. So before going any further, we will understand like what is basically securities. So in simple words, a security is basically a financial instrument that holds any monetary value. So of course, if we both exchange the security right now with each other, so it holds any monetary value. So it means like it value can increase and decrease with time, right? And this can be used to raise capital in both public and private markets, like secondary and primary markets, of course. So now we will be seeing the types of securities. So basically there are only major three types of securities, which are equity, debt, and derivatives. So equity, so coming to the like, why should we care about these securities? So we should know we should know these things about securities because they help us in providing the basic concept of how the securities market works in general. So basically, if talking about the equities, so it provides ownership rights to the holders of the security. So if you own the shares of Reliance, so you have some basic proportionate of ownership in the Reliance company, right? So coming to the debt part, so debt is basically a loan type of thing, which is basically you are paying the periodic payments of the interest and gaining the amount of arbitrage opportunities which have been generated by the debt, right? And we then have the hybrid and derivatives part, which is the combination of both equity and debt aspects. So they are, derivatives have the own monetary value subsiding from the main underlying asset of the asset value. So they gain their value from the underlying asset, right? And comparison now comparing the average ROI of these three securities over the past 10 years. So as you can see on your screen, like equities have given 17.87% returns in the past 10 years on average. And generally the risk is on the higher side. So if you are risking your capital on the higher, on the higher segment, so there are chances that you are gaining the higher returns, of course. And as in comparison with the bonds, so bonds have have the lower risk, so they have been performing quite neutrally around the past 10 years, and they have been giving 6.67% returns in the past 10 years. And seeing these derivatives, their risk is always on the higher side because they gain their value from the underlying assets. So if their value moves drastically when the underlying asset price move up or down, so basically they have been given like 16.21% returns in past 10 years. So generally the risk is on the higher side on the derivatives because their underlying asset can move drastically, and which can cause the many drastic changes in their value. So yeah, and talking about some interesting facts that you should know about the securities. So you know that if you are considering investing in the securities, so you should not do in September, because historically it's the month that when the market has performed the worst globally. So if you, and that's the fact that the also the analysts know about these things. So yeah, it's just a general fact, like it's a fun fact to have a quick grasp of how the things work in the global markets. And the fact number two is like bond market is larger than the stock market, which is around $100 trillion worldwide. So we have seen that the equities give much more higher returns than the bond, but then it generally should have the more value of worldwide than the bond market. But it doesn't happen like this, because bond market, it has been considering both as the public and private market as the base subsidiary. So the debt is the most safest bet you can have on, and you generally get the interest rate payments on the fixed rate of interest. So if the government is issuing these debts, and the bonds have been issued by the government and the both private players, so it generally depends on how they have been configuring and accumulating the interest payments by far from the past several years. So yeah, that's why the bond market is much larger than the stock market, of course. So coming to the part like how it affects the economy. So basically, security makes the market more efficient. So it gives you more choices, of wide range of choices, like in which security you should invest to. You have about how much you risk you can take on each type of investing in security. So let's say if you want to play safe and you have to retire, so you can invest in debt. But if you have much more time left and you are in your early 20s or 30s, so you can also invest in the securities like equities, which give you much more higher return with the highest risk capacity if you have that. And so yeah, as being saying this as I'm saying this, so it makes trading investing much more easier and hassle free, of course. And as more and more players are coming into the market, so it adds up to more liquidity, but it has also the disadvantage on the other side, because it creates the more liquidity creates much more volatility. So it makes the movement of the prices of assets a much more in a wider range. So the prices can fluctuate very drastically when at certain times, right. And but yeah, good decision and judgments lead to a successful and happy investing life. So it depends on how much risk capacity and good decisions you make while you are investing in the securities, right. And yeah, so the as you have been listening that in the news also, the retail investor is the biggest player in the stock market. So as you can see that in the past 5 years, the retail participation has grown drastically, like by 9%. It has grown like from 36%. We have now been witnessing 45 to 47% participation in the stock markets. So this is very phenomenal. Like also the discount brokers have been issuing and making this process easier for investing. So many teenagers have been investing in the stock market, which is a very good thing, of course, because the early you start, the earlier you have the time period of the long term investing, and that's how the compounding works. So yeah, basically, if you are choosing the right stocks and at the right time, and you're investing a surplus amount of money into those things, into those securities, so they can give you much more greater returns in lifelong period of your investing period. So yeah, that's how it works, and that's how the compounding works in general time frame. So this, as you can see on your screen, that this is the 5-year client participation graph. So it shows like how the individual investors like retail participations, corporate companies, FII and DIS operate. So FIIs are basically foreign institutional investors like JP Morgan, Goldman Sachs, and HSBC, which are the foreign players which play in our market. And DIS are domestic institutional investors such as HDFC, Kotak Bank. These are the domestic institution players in our market. So you can see that the retail participation has grown much greater than the these institutions and these corporate players, right. And now understanding the derivatives part, because derivatives is much more lucrative place to be held in, because if you talk about the equities and debt, so you already know about these things, right. So derivatives are much more riskier, but you can have much more plentiful returns from these derivatives part. So basically, derivatives are financial contracts set between two or more parties. So let's say, like we exchange some derivative parts, and we come into the contract, mutual contract, like we will like bet on the future price of anything. So basically, they derive their value from the underlying asset, right, or a group of assets, it depends. So it can include various types of, like you can see on the chart, like we have options, forwards, futures, swaps, and additional contracts which basically depends on the existential equities or debt market players, right? And we will understand these things in much more deeper stages. So yeah, coming to what do they mean by, like, as I've been saying this, like what futures, forwards, options, swaps mean. So basically futures are agreement between two parties for the purchase and delivery of an asset at agreed upon price at a future date. So you don't have to, if we come into the future contract, so you don't have to pay any price right now, but your, your profits or losses depends on the price that asset will hold, an asset contract will hold after a certain period of time, right? And that's how it does forward contracts also work. So basically forwards are also like futures, but they do not trade on exchanges. Buyers and sellers may customize the terms, size, and settlement, but it offers counterparty risk. So basically if we are moving into the forward contract, but there is no regulator as such to regulate those contract as such, if any violation happens, so there can be a counterparty risk, like someone can violate the terms and you can have to pay the price. So for that, so yeah, basically forward contracts are much more riskier side of derivatives, and if they are not cash settled, so, and they don't even trade on the exchanges, so you have to be safe while having those derivatives, when you're indulging those derivatives. So, and coming to the options, so in this case the buyer is not obliged to exercise the agreement or to buy to or sell. It is an opportunity, basically not an obligation as futures are. So futures are the obligation that you have to fulfill if you are coming into the contract, but the options gives you the opportunity, like it doesn't hold any, you can exercise your options contracts before the expiry date. So you have the flexibility, like you are not obliged to do anything, but you have the agreement, you have the right and you have the opportunity to come into contract and play this the more riskier bet, and the more, like you can do option buying and option selling at such, with the much more larger appetite of risk. And talking about the swaps part, so basically they are used to exchange one kind of cash flow with another. So for example, I am switching my loan from a variable interest to a fixed rate interest. So it depends between the countries, the governments of different countries. So they have been creating swaps from many years, and they exchange these swaps because of the how the market, if suppose there is a for example, US is exchanging the swaps with the Indian government, so they give their authority and protective swaps that they have been providing us, the like we have the growing economy, so they give us the fixed rate interest loan from the variable interest loan. So yeah, that's how the swaps work on the basic general side of the market. So as such, as the risk is included also, so we will talk about some advantages that derivatives hold. So first of is like they are in lock-in pricing adjustment. So there's much more flexibility, like how you have been, it depends on you, like how you have to customize your contract, how you have to select a settlement date. So it depends on your wish and your authorities. And second thing is that it provide hedge against your unfavorable movement. So if an asset is moving, much more violent moves, so you can purchase, like you are buying some securities, like you are buying some equities, but you can at the same time sell the futures of that equity, that asset also. So it gives you the hedge against the unfavorable movements, like if a company stops working, or if a company goes bankrupt, so you should not be harmed against, those natural laws. So it additionally gives you hedge against the unfavorable movements. Of course it requires some much more capital, but yeah, it gives you hedge against those unfavorable movements. And as I've been mentioning this, so third point is it helps in mitigating risk. So the risk is quite minimized, but it is not, if you're investing in the markets, or you are coming into the mutual contracts, so there is always the risk if it is included with money. So yeah, the risk is reduced, but it is, it cannot be eradicated as such as a whole. And as we should also know the disadvantages about derivatives. So the worst thing that can happen to you in a contract is like that the change in time value near expiry. So basically the time value is basically the value of a contract which changes drastically with time also, and with the intrinsic value also. So if the time value changes near the expiry drastically, so it can give you much huge losses because of the time value it holds. As the time value decreases when the expiry comes near, so if the intrinsic value is not also increasing and the time value is decreasing as such, so your contract value is losing much more value as such, as in general, because it will give you much more losses than the, the minimum you have, the initiation contact cost that you have been given. So the you have to look into that also, to if you are going into some contracts which have been mutually decided, so you can discuss with the counterparty, so they can, be flexible with this thing. So coming to the second disadvantage. So yeah, it can be sensitive to cost of holding the underlying asset. So yeah, as I said, that they derive the value from the underlying asset, so it obviously, it is sensitive to the cost of the holding of underlying asset. And third thing is much more important, because susceptible to variable interest rates. So if you are going on a contract on, suppose, a bond, and you have been saying that the interest you are going on a future contract, like the interest rates will be hiked in US, like for example, the interest rates will be hiked in US, and you are saying that the interest rate will be, going up against your order and your contract. So you buy a future, like, you are betting against that the interest rates will be hiked in US. But if something unfavorable happens against your move, so it depends on, like, if variable interest rate, so you should be advisable to your destiny, and you should be advisable to your, like, how you have been promoting it with the help of these things. But you should not never be going against the interest rates as the more underlying asset, because it may ruin your whole contract, and it may ruin your whole premium of SDK as such, because it depends on, like, how you have been working on those things. So you have to keep in mind that thing, like how these things work. So coming to the main part of the presentation, so how has technology shaped the financial industry? So these are some points which have been, which have majorly drastically changed in the last 5 years. So basically, there is much more diversification, and the economies of scale have been extended hugely. So there are now much more options to choose from. So there is much more divisibility. So as I've been mentioning this, so for a quite long time, that there's much more retail participation in the market, so there have been much more money in the stock markets. So the liquidity has been increased very huge amount, and customized management has also been there, but the risk has also been reduced. As I've said, that there have been derivatives part, so, and the technology has played a major role in shaping this industry. So the risk is reduced, but it is not eradicated at all. So yeah, you can say that the technology has shaped the financial industry on a much more brighter side. And coming to the how Web3 is already transforming finance. So Web3 is a concept which is basically the which basically includes the whole idea of the traditional shortcomings creating new opportunities. So basically, DeFi is the reinvention of the traditional financial products, including market and trading exchanges. Lending and borrowing has been made much more easier, which uses blockchain and Oracle's network. And we are reaching the new milestones in mainstream and institutional adoption. So basically, DeFi is the fastest growing segment in 2021. You have seen that $18.7 billion have been, the log period has been shifted to $252.46 billion, which is a 12x increase, 12,100% increase. And the key technologies underpinning blockchain and DeFi are poised to disrupt the $867 trillion in traditional markets. So it is hugely, transforming this industry, the finance industry. And builders are much more focused on obstacles to adoption. So DeFi's rapid adoption has corresponded with the launch of Oracle networks, with the aggregated need of financial data from real world sources into blockchains. So it has been transforming this as a whole bunch of things. So you can see the Web3 development model, like how the runtime modules and development tools have been taking the much more congruent part of the Web3 basis, and cryptography bridges, APIs, language development, runtime environment development toolings, UI development, wallets have been the major segment to the constituting around 51 to 52%, and the development tools and runtime modules have gaining the traction 49%. with the 49% increases. And but as the every coin has two aspects, so Web3 has been also has been very good, and have been very transparent from the beginning, but it comes with the drawbacks and loopholes also. So there is low accessibility to everyone, so no, not everyone can access the Web3, and it cannot be, the web it cannot be accessed to from every device as such, and you need much more higher internet speed to access this Web3. So also the public and private information can be served easily. So your data is not safe at all on Web3. So as much more regulation and more, the transparency comes, and the much more, the blockchain and the network increases, and the, the strength increases. So it depends on that things, like how they have been, how these things will turn out and work. And as said, that they are tough to regulate, and there is no regulatory body in blockchain, so this cannot be regulated as in a while. So it is that's why, the information can be served easily, and it can be misused on anything. So yep, that was it for our presentation. So thank you for listening to me, and you can contact me anytime. So I will be sharing my contact details at the end of the presentation. And and this is about like how the technology and, DeFi has been working in our industry, and has shaped the economy in the brighter side. So yeah, this was it, and these are my contact details. So thank you guys for listening me so patiently, and thank you once again.